So, what exactly is a subprime mortgage? Well, to get our heads around it, let's just start with a super simple story. It's a story that probably sounds pretty familiar. You want to borrow some money, so naturally you head to a bank. Okay, so you do the whole song and dance, right? You fill out all the paperwork, you wait, and then you get that call. Bad news. The bank says no. And you're left wondering why. Well, a lot of the time, the reason they say no comes down to just one little number. Yeah, that's your credit score. You can kind of think of it as your financial report card. It's the bank's quick and easy way to look at your history and see how you handle your money. A high score? Awesome. That tells them you're a pretty safe bet. But a low score? Oof, that's a red flag. It screams high risk, and if there's one thing banks hate, it's risk. So that brings us to what should be a pretty straightforward moment, the initial rejection. You've got a borrower with a low credit score walking into a bank, and remember, that bank's number one job is to be super careful with its money. The bank takes one look at the numbers and they give a perfectly logical, responsible answer. They see that low score and they say, nope, sorry. It's nothing personal, just a simple business decision. The loan is just way too risky. But this is where our story takes a really interesting turn. So, what if you couldn't change the borrower's riskiness, but you could change how people talk about that risk? What if you just changed the words? This, right here, was the first clever and kind of sneaky step. It was a total rebranding of risk. And it really is all about the power of words. Think about it. The term bad credit, it's pretty blunt, right? It sounds judgmental. But then you hear subprime. Ooh, that sounds all technical and professional, doesn't it? It sounds like some fancy financial term. But it's just a mask for the same exact thing, a high-risk borrower. The person hasn't changed, the risk hasn't changed, only the label did. Okay, so now that the language has been softened up, a brand new player steps onto the field. And this is a big one, the government. This is the moment a simple yes or no from a bank starts to get really complicated. Now, the reason they gave, the official political goal, was to fight something called discriminatory lending. So the government basically started leaning on the banks, pressuring them to say yes to the very same loans they had just said no to for perfectly valid financial reasons. So, how'd they do that? Well, they used the classic carrot and stick. The stick was pretty heavy. They threatened banks with legal action from the Justice Department. But the carrot? Man, the carrot was the real game changer. They created these huge government agencies, you've probably heard of them, Fannie Mae and Ginnie Mae, and their job was to guarantee these risky loans. And this guarantee, it completely flips the entire script. I mean, think about it. Now, if one of these subprime borrowers can't pay their mortgage, does the bank lose money? Nope, not a single penny. The government agency just steps right in and pays the bank back. Poof! For the bank, the risk has literally just vanished. This totally changes the incentives, you see. Everything is different now. With the risk completely gone, the bank's whole way of thinking changes. What was just a moment ago a really bad bet is now maybe the safest, most perfect investment you could possibly imagine. Let's rewind for a second. Remember this? Sorry, too risky. That was the bank being smart, doing its job. They were managing risk, and this kind of loan was, by definition, a risk they didn't want. And now, a total flip. The very same banks are suddenly screaming, give me more, give me as many of these people as you can find. It's a complete 180. So you have to ask yourself, why? What changed? And here's the answer, it's the whole point. That loan is now backed by Uncle Sam. We're talking about a guarantee from the United States government, which is considered the best credit in the world. For a bank, that's like finding a golden ticket. It's a totally risk-free investment. They get to collect all the interest payments, but if anything goes wrong, they bear absolutely none of the risk. But of course, this didn't just stop with one loan at one bank. Oh no. This new risk-free product was so incredibly attractive that it started to spread everywhere like wildfire. It went systemic. And that's how a bunch of individual loans started turning into a massive potential crisis. So here's how the whole machine worked. Step 1. Banks started handing out these government-backed loans like candy, thousands of them. Step 2. They'd take all these loans and just bundle them up together, packaging hundreds, sometimes thousands, into one big financial product. And then, step 3, they'd sell that entire package to other investors all over the world who were just as excited to get their hands on what looked like a perfect risk-free asset. And the end result of all this originating and packaging and selling, well, that original risk, The actual person with the shaky credit history, that risk never went away. It wasn't eliminated, it was just hidden. It got chopped up into a million tiny pieces and sprinkled throughout the entire global financial system. Which, brings us all the way back to the big final question. This entire thing started with one loan that a bank in its right mind said was too risky. But then politics got involved, government guarantees entered the picture. The risk didn't magically disappear, it just got moved, it was transferred. So it leaves you wondering, right? When it all comes crashing down, who's actually left holding the bag? Who truly bears the risk?